Welcome back to the channel. A lot to unpack this week. CPI headline inflation came in lower than expected at 2.7%. Now the conversation is whether or not the Bank of Canada will cut next week on July 24th, or will Canadians have to wait until September to see some policy rate relief from the Bank of Canada? And ultimately, what data points are going to be pushing potentially the Bank of Canada to cut as early as July? Or are they going to wait for more data? That is really the question, the conversation that's happening right now. So make sure you subscribe to the channel so you can stay up to date with what's happening with the Bank of Canada, these inflation numbers, and obviously what's impacting mortgage and real estate right here on our channel, Finance Fridays. So let's get right into this conversation right now. So headline inflation eased to 2.7%. That's headline, coming in a little bit lower than the previous month of May, where we saw that tick up to 2.9. Now, ultimately, that was pretty alarming. That did put the media and economists and analysts into a frenzy, basically kiboshing any possibility of a Bank of Canada cut in July. But the tune has now changed as inflation has pulled back. Those job reports numbers coming in at 6.4% just a few weeks back obviously give the Bank of Canada some ammo or some cover to potentially look at cutting as early as July. Now, ultimately, will they cut in July or will they cut in September is anybody's guess. But ultimately, if we start compiling a lot of the data, we look at obviously how the inflation numbers are broken up. Remember, the Bank of Canada does really focus on core measures of inflation, CPI core, medium, and trim. And trim coming in at 2.9, and we did see some pullback in some of these other core measures. Now, ultimately, this is good news. This is what the Bank of Canada wants to see happening. If you recall, the Bank of Canada does note that it understands that there's going to be ebbs and flows, peaks and valleys in these inflation numbers as we get to 2% by 2025 at some point. And ultimately, we're going to see some little bit of crossroads happening right now. The Bank of Canada fully aware of it. So if you recall, Bank of Canada's major focus, its mandate, is to bring that inflation back down to 2%, and also has a small weighing in on the Canadian economy and the labor market, making sure that Canadians are employed, that they're healthy and able to pay and work. Now, if we really look at some of these CPI numbers, we're starting to see some consumer pullback. Ultimately, some things are still elevated. Obviously, biggest thing that's pushing CPI inflation onwards and upwards is the mortgage and interest cost. Obviously, as interest rates continue to remain elevated, many Canadians renewing into higher rates, many anticipated to be renewing into relatively higher rates. This is ultimately going to draw this number up. Now, the real question is, how do Canadians feel about Stats Canada? Is the inflation numbers reported accurate, or are they inaccurate? And this has really been a hot topic with a lot of Canadians, but let me know in the comment section below what you think about Stats Canada's ability to report these numbers. Now, ultimately, as we move forward, let's look at some of the other data points. I mean, ultimately, we talked about the unemployment rate coming in at 6.4% just a few weeks back, ultimately higher than expected. We also got those GDP numbers at the end of June, growth in the economy, really nothing to call home about. Pretty lackluster numbers, ultimately showing that the economy is slowing. And we also have those higher immigration levels that are skewing some of these numbers when it comes to productivity, comes to GDP per capita. Ultimately, Canadians are not feeling as better off as they were maybe just 10 to 15 years ago. So this is a really big question. Bank of Canada does see all this data in front of them. And more importantly, they got their business outlook survey and their consumer outlook survey. And if we take a quick glance at some of these documents, we look at what the consumers are saying, what Canadians who have been surveyed are saying, while ultimately they're saying that, hey, inflation is a bigger problem than potentially mortgage interest costs. As we do know, a lot of Canadians own homes, a lot of Canadians don't own homes, a lot of people are renting. Generally, renters are disproportionately impacted worse, or more, I should say, when it comes to inflation and how these costs are passed on, because those with assets, as we know, have the ability to potentially lever up on those assets to let them weather a potential storm by maybe refinancing their mortgage or selling off one of their assets. But those who don't definitely feel it. Now, remember, another important component is that the Bank of Canada has literally pointed to the fact that they are not there to rescue the housing market. They are there to protect Canadians and inflation from getting too hot, because inflation impacts everyone. Mortgages only impact those who are interested in housing. So we have to keep that distinction in mind. We've talked about it on several occasions on the channel that the Bank of Canada does not really focus in on the housing front. Now, one thing I do want to point out is that with the fact that the Bank of Canada did cut in June 0.25%, and now we're looking at the real estate market, we haven't seen a significant uptick in Canadian sentiment when it comes to purchasing real estate. Now, because of that, I mean, ultimately the Bank of Canada probably likes that data because it means that, hey, there might be some cover for them to cut a little bit more. And if Canadians aren't rushing back to the real estate market, it allows them the opportunity to do their job, to basically tackle the Canadian economy, breathe some life back into it. Because ultimately right now, if you think about consumers, they do think that inflation is going to be coming down eventually. And we just want to avoid and prevent these expectations. Remember, the Bank of Canada talked about consumer expectations. Where do we think inflation is going to be today or tomorrow? And if we think that inflation will be back to 2% tomorrow, then Canadians are going to wait to buy those big ticket items as opposed to buying them now because they think they're going to get more expensive in the future. So that's an interesting way to look at it. And we have the Business Outlook Survey, which for me is a pretty valuable tool because business in Canada is ultimately suffering. We did see a lot of capital leave Canada. We see a lot of investors leaving Canada. And if we start to see all the businesses sort of pick up and leave or try to figure out ways to pay less or avoid certain taxes, then ultimately that's going to impact the Canadian economy. And certain businesses are definitely preparing for a recession. They're obviously looking at their employment, the job vacancies. Maybe they're going to be hiring less over the next few months. They're going to be anticipating, potential inflation coming down. So, they're going to plan accordingly based on what they feel. And this ultimately, in conjunction, really a good sign for the Bank of Canada, especially because it does look at these two surveys when making their monetary policy decisions. But ultimately, it is really a mixed bag on what the Bank of Canada will do next. I would probably say, if I had to go with my spidey sense, I would say that the Bank of Canada will be cutting in July, but really, I don't know if they will actually pull the trigger. They may want to wait for some more data in September. Now, the only thing that's pushing me more into the direction why my spidey sense is sort of going off is because of what's unfolding right now in the US. And ultimately, yes, the Canadian economy, the Canadian currency is all independent of the US. But as we've said on many occasions, if the US sneezes, Canada does end up catching the cold. So what does this mean? Just last week, over the weekend, we saw an assassination attempt on President Trump, the former president. Now, putting all the politics aside, whether you agree or disagree with him, it's really important to understand that markets, whether it be the housing market, bond market, it's the stock market, they strive and yearn for certainty. And if this means that this person, Donald Trump, will become the next president of the United States in the upcoming election, well, how does that change the market sentiment? What does that mean for businesses in the US? What does it mean for interest rates in the US? What does it mean for deregulation and basically bringing back pipeline and oil? You have to take that into consideration. As I said, all politics aside, markets look to these things for direction. How are they going to perceive that? Now, ultimately, that is one set of conversations. Let us know what you think about that in the comment sections below. But ultimately, Jerome Powell, the head of the US Federal Reserve, the chair of the Federal Reserve, came out, talking about policy rates, talking about weakness in the labor market, I should say. So definitely some pullback happening in the US as of right now. And that is also coupled with the fact that they're now saying that maybe we're not going to have to wait for inflation to go back to 2% before the US cuts. And why is all this really important? Well, as I mentioned earlier on about the Canadian exchange rate, remember when the Bank of Canada cut, a lot of people were saying, well, if they cut, what is going to happen to the Canadian dollar? And ultimately, when they did cut back in June, there was a slight knee-jerk reaction in the Canadian exchange rate, but that rebalanced. And now we're starting to see the US show signs that they're looking to cut rates. And if they actually start cutting rates, so this conversation becomes a little bit more put to the forefront as it is right now, well, you see markets react. You're going to see the bond market react. And based on all this news, we're starting to really see some of these bond yields pull back a little bit. They've come off some of their highs. Ultimately, still a lot of room to go for many Canadians who are looking for those extra low rates, which I don't think we're going to see. However, ultimately, what is happening right now is if we see the US cut, we definitely will see some easement in the 5-year Bank of Canada bond, which, as you recall, is the barometer, the best way to gauge what is happening with fixed rate mortgages. Important note, even if the Bank of Canada cuts next week on July 24th, it doesn't mean that fixed rate mortgages move in lock and step. What happens to the variable rate mortgages is all based on what happens with the Bank of Canada. Now, there might be some knee-jerk reactions in those bond yields. Ultimately, we don't know what the Bank of Canada will do in July. As I said, my gut feeling is that they will end up cutting in July for sure. If they don't do it, September is a shoo-in. Ultimately, they're trying to land this soft landing. The soft landing being avoiding a recession by balancing inflation and employment, making sure we have maximum employment, but we have inflation coming back down in alignment, and landing this very big airplane on a very small runway is a very tall task. And they just are doing this, in my opinion, and this is literally my opinion, maybe I share with a few of our viewers out there, but if the Canadian economy doesn't actually pick up, if we don't see unemployment rise further, we start to see the economy get worse and worse and worse, then the Bank of Canada has to do more and more and more when it's ready to bring that economy back to life. If they do things slow and steady, they can slowly turn those gears, or all those gears up, without having to really impact the economy and really send potentially real estate or inflation or any other components in the economy out of whack. That is literally the whole point. This is how delicate this situation is right now. And I wanted to leave the video here, leave you with those thoughts. Let us know what you think in the comments section below. But ultimately, at the end of the day, don't forget to subscribe, leave those thoughts, questions, and comments in the comment section below. We'll see you next week.